Bond yields have been ticking higher of late. Here to tell us whether or not it's a real move up or just a head fake is Jim Kochan from Wells Fargo Funds. Welcome, Jim.
Thank you.
So do you think this recent move up in rates is the real thing, or are they going to be headed back down just as quickly?
I think we're still in a trading range for most bond yields. Yes, it's a half a percentage point back up in yields or an increase in yields, but I don't think this is the start of a bear market in bonds, a prolonged uptrend. The fundamentals that drive interest rates just don't support that view that we've embarked on a bear market.
All right, so what are the fundamentals of the economy as you see them? Is the 10-year reflective of what's going on in the economy, or is it just Fed manipulation?
No, I think it's reflective of what's going on in the economy. Overall, the yield is still very low, and economic growth is slow. Inflation is low. It's not accelerating. The leading indicators of inflation are quite tame. Money supply growth and borrowing in the U.S. economy is weak. Money supply growth isn't very strong. Unit labor costs are not growing very rapidly. These are leading indicators of inflation, and they're very mild. So you add up the fundamentals, and the 10-year yield is probably about where it belongs, somewhere in the neighborhood of 2%. I've been using a range of 1 3/4 to 2 1/4, and I'm still comfortable with that range.
That said, there have been cries that the Fed is manipulating the bond market. To how much of an extent is this true, in your opinion?
There are some, I wouldn't like to use the word manipulation, but for example, their purchases of mortgage-backed securities. Here's a market where the overall volume of outstanding mortgages is shrinking cyclically and structurally, and they are buying $40 billion a month. So they have, in fact, contributed to a very narrow yield spread between mortgages and treasuries. So that has that's been a pronounced influence. As far as the treasury market is concerned, there's been some influence, but there are other buyers in that market who have been absent, the foreigners in particular. Last week we saw data that the foreigners have been big sellers of treasuries. So they're just as important as the Fed in the treasury market.
So which areas of the bond market do you like?
I like those areas that have performed well over the last 12 months, actually over the last 2 to 3 years. We still like the high yield corporate market. It's had a nice correction here, so there's some value there again. I like the municipal market, single A and triple B credits in the muni market. Again, there's been a backup in yields, a fairly significant one, and there's some real value in that market again.
What about emerging market bonds? We're seeing riots in a lot of emerging market countries, whether it be Turkey or Brazil or Indonesia. Should this scare people away from these bonds? Because for a time, a lot of people said they'd rather own Brazilian bonds than U.S. treasuries.
Well, I think there's been an underestimation of the risk involved in emerging market debt, maybe even in emerging market equities, but my area is debt. And you're not getting paid all that much relative to domestic high yield to own emerging market debt. I would underweight emerging market debt in favor of domestic high yield bonds in my portfolio recommendations.
Thanks a lot, Jim.
Thank you.
And thank you for watching The Street.